Corporate Finance Core, Topic 11, Personal Finance and Investing, Learning Objective number 4. We're going to learn how to incorporate portfolio risk into a stochastic retirement planning model. And what I mean by stochastic, it's probabilistic, meaning that more than one outcome could happen, and trying to run a simulation to try to figure out the probability of having enough money. So to do that, again, I mentioned this at the end of the last topic. The previous model I gave you, we call it a deterministic model or a static model, meaning it's non-probabilistic. It doesn't incorporate risk. So implicitly, the returns I put in there for stocks and bonds and cash were risk-free because it just assumed that they were going to happen. There's no other alternative. Now, if we assume that those returns are normally distributed, we can estimate the risk of our portfolio if we know the expected returns, standard deviations, and correlations among the assets. Now, the portfolio standard deviation, if I look at, say, just stocks, bonds, and cash, and I'm trying to figure out what is the expected return and standard deviation of that portfolio. Now, the expected return is simply the weighted average. We did that with the sum product. The standard deviation is not the weighted average. It's always going to be something less than the weighted average because of the diversification. Sometimes some assets are up, and sometimes at the same time others are down. There's just a lot of randomness and non-perfect correlations among assets. So when you put assets together, you get a diversification benefit. Now, if you want to look at how assets are correlated, you can create a correlation matrix. So if you have stock or asset class 1, 2, and 3, you can look at all the different combinations of correlations. So this row is the Greek letter rho is going to be my correlation representation. So correlation 1, 1 will be the correlation between asset class 1 and itself. 1, 2 is asset class 1 and asset class 2. So like stocks and bonds, and 3 might be, say, stocks and cash. So when you do a 3x3 matrix of all the different correlations among 3 asset classes, they'll give you all the different combinations. And by the way, the correlation between any asset and itself will always be 1. So that major diagonal is going to be a set of 1s. So how do I get portfolio standard deviation? Well, we're not going to spend a lot of time on this slide. It looks pretty nasty, but let's just say to get the portfolio standard deviation, I need to know the absolute risk of every asset. So I need to know what is the standard deviation of each asset. And then I need to know the correlations among all the assets. And I need to combine that in such a way as to get a number that combines both of those. That number we're going to call covariance, which is a function of both the standard deviations and the correlations. And if you look at all the different covariance terms among your portfolio assets, you can then calculate the portfolio standard deviation. Again, we're not going to talk too much about how it's derived, but just the insight into understanding that the overall portfolio risk depends on both the risk of each asset measured by standard deviation and the correlations among all the different assets to account for standard deviation. So in the spreadsheet, I'll just show you how I'd implement this in the spreadsheet. So for example, I'm going to come up with some historical standard deviations for cash, bonds, US stocks, and foreign stocks. And you can see I'm using 18% for US stock standard deviation, long-term average, a little bit higher for foreign stocks, 5% for bonds, and 1.5% for cash. Here are some data that I collected for correlations. So this is, you can see the correlation matrix. The correlation between an asset and itself is always going to be 1. So you can see stocks and stocks is 1, and so on. I have the correlation between, say, money market. Actually, both of these could say cash here. The correlation between bonds and cash is about 0.45. Based on a data set that I have, the correlation between cash and US stock market is 0.073 negative, and so on. So this gives you some correlations. And we're going to use these to, actually, I just did a little error right here. Let me fix that. I'll just make this the same link as this. US stocks and foreign stocks have the same correlations as cash. All right, so I have these correlations. Now I'm going to calculate numbers called covariance terms that combine the standard deviations of each asset and the correlations. How we do that in Excel is this little trick. I'm going to select this entire area here. I'm going to say equals. And then I'm going to put in the correlation matrix times those 4 standard deviations times a transpose of those 4 standard deviations. Control Shift Enter. These numbers, each one of these numbers now represents a covariance matrix. And that covariance matrix tells you all the covariance terms. Now I can use that to calculate the standard deviation of this portfolio. That's 0% cash, 10% bonds, 54% stock, and 36% foreign stock. The formula there is a matrix algebra formula. Again, I won't go into that, but I have some links at the end. I can show you other lectures that I've done in financial modeling that might spend an hour kind of talking where that formula came from. But I'm going to take that little quote out of there and do Control Shift Enter, and there it is. The expected standard deviation of my portfolio is 16.6. Notice if I did a sum product using the weights and the standard deviations, I'd get 17%. So that difference between 17% and 16.6 is the diversification benefits, given that all these correlations are not 1. Actually, if I changed all these numbers to 1, I could prove it to you. If I changed all these numbers to 1, the standard deviation becomes the weighted average because there were no diversification benefits. They all move exactly together. So I'm going to put that back. And I have the formula down here in my spreadsheet now. This is the exact spreadsheet we did in the last section, calculating the deterministic portfolio balance. I'm going to take away that single quote, Control Shift Enter, and there's my 16.6. I'm going to copy that formula down so you can see my portfolio is getting safer over time as I get out of the risky assets of stocks. And now I'm going to do my another formula here. The expected return at age 30 is 7.18%. However, given that there's risk of standard deviation of that return is 16.6%, there's you can estimate the probability that'll be, say, the expected return plus or minus 1 standard deviation. Well, if you want to make random portfolio returns, a random model, a probabilistic model, you could do this formula. The random return in year 1, age 30, is going to be the expected plus norm SIMV rand open, close, close times the standard deviation. So let's look at that again. It's the expected return plus norm SINV open rand open, close, close times the standard deviation. Now notice every time I hit F9 it just gets the spreadsheet to recalculate all cells. So every time I hit F9, I'm getting a new random portfolio return. So again, the market is risky. We don't know what the return is in any given year. Now, if I hit F9 enough times, what you'll notice is the average number. If I did this, say, 10,000 times and recorded all 10,000 of these portfolios, the average number will be 7.18. And if you graphed it, it would have an exactly a 16.6% standard deviation. So this formula here ensures that we get a normal distribution of returns given the mean and standard deviation. Now I can copy that down. So now you have a lifetime of risky stock markets. Sometimes you get kind of a few years of a depression, and sometimes you have some great years and you're making tons of money. So I now can do my random portfolio balance, or my risky portfolio balance, and that would be the previous balance times 1 plus the risky return plus my contribution or withdrawal. I'll copy that. Let me get rid of one of those decimal places, 2 of them. I'll copy that down, and notice I'm going to go down to the bottom here. In my deterministic model, I ran out of money here. What age was that? I was 91 years old. I ran out of money. That's when the first negative showed up. Now, it looks like on this randomness, I ran out of money, looks like at least 10 or 15 years earlier. But if I hit F9, oh, still ran out of money a little earlier. F9, ran out of money. If I do this enough times, you get some outcomes where the market is very good. So that's actually about average. So what I could do to determine whether I've saved enough money would be to take this last number. Say Jordan, again, her goal was to have enough money to last to age 95. Age 95 is this last row in the spreadsheet. So what I could do is every time I have F9, every time it's a positive number, I'd record it. And oh, I'm sorry, I just hit F9 and I record whatever's in L83, say 10,000 times. And then I take the percentage of times that that number is negative. That's the percentage of times I ran out of money. And that's how you'd assess the risk of this portfolio or this savings plan. So the next model I'm going to show you incorporates that. It actually has a macro that's written and kind of uses the same logic as this spreadsheet here, but it has a macro that's written that will record the final value at retirement and tell you on average what percentage of the time do you run out of money, what percentage of the time do you have enough money. So this is the basic understanding of how most models of personal finance will calculate the probability that you'll have enough money.